Good morning everyone. Today we are going to present our group assignment 1, which focus on the Basel Commit on Banking Supervision, also known as BCBS. In this presentation, we will discuss the background of BCBS, its objective and roles, as well as its importance in the banking industry. So without waiting much, let's go. For this presentation, we have 8 main parts that we are going to discuss. First, we will start with introduction. Then, we will discuss the function of the Basel Accords. Next, we will look at the relationship between BCBS and Islamic banking. After that, we will discuss some of the challenges faced and share our reflection on the topic. Finally, we will conclude the presentation by summarizing the key points that we have discussed. So now I'm going to introduce BCBS, which stands for the Basel Commit on Banking Supervision. First, let's look at the history of BCBS. The Basel Commit was established in 1974 by the central bank governors of the Group of 10, or G10 country. It was created mainly to strengthen international banking supervision. At the same time, there was a need for countries to cooperate more closely because problems in the banking sector could affect other countries as well. Next, what exactly is BCBS? BCBS is an international committee that develops banking standards and guidelines for countries around the world. Its main purpose is to improve banking supervision and help banks operate in a safer and more stable way. Although BCBS does not directly control individual banks, its standards provide a common framework for banking regulators. These standards also help maintain financial stability globally. Now, moving to why BCBS was established. There are several important reasons. First, it was established to strengthen banking supervision so that banks can be monitored more effectively. Second, BCBS aims to promote international cooperation between banking regulators. This is important because the banking system is connected across different countries. Third, it helps to reduce risk in the banking sector by encouraging banks to have proper risk management and sufficient capital. Finally, BCBS helps to increase confidence in the global financial system. When banks follow proper standards and manage their risk effectively, people and businesses can have greater confidence in the financial system. In conclusion, BCBS plays an important role in making the global banking system safer, more stable, and better supervised. Its standards help countries work together to manage banking risk and maintain financial stability.
Good morning everyone. My name is Muhammad Amir Mushib bin Akhardi and my matrix numbers is A25B4469. Today I will continue our presentation about the function of the Basel Committee on Banking Supervision. First, I think one of the important functions of BCBS is to develop banking standards. BCBS making global banking rules and standards to guide banks. It also encourages banks to have enough capital and promotes good risk management in banks. Next, we have strengthening banking supervision. I think this is important because bank needs proper supervision to make sure they follow the rules. BCBS helps improve banking supervision in different countries. It also supports cooperation between banking regulators and improves transparency and accountability in banks. The third function is to maintain financial stability. In my opinion, this is important because a stable banking system can help reduce financial problems. BCBS helps banks become safer and stronger. It also works to reduce risks in the banking system and helps prevent banking crises and financial problems. Lastly, a BCBS helps to protect the public and the banking system. I think this function is important because customers need to feel safe and confident when using banks. BCBS help protect customers and increase confidence in the banking system. It also supports a safe and stable global financial system. So in conclusion, I think BCBS plays an important role in making bank safer, stronger, and more stable. That is all for my part. Thank you for listening.
Basel Frameworks Basel 1 Basel 1 introduced by the BCBS in 1988 established the first international standard for bank capital adequacy. It required internationally active banks to maintain a minimum capital ratio of 8% of risk weighted assets, with assets classified into risk categories from 0% to 100%. Basel I mainly focus on credit risk. Requirement Capital requirements are bank must hold at least 8% of risk weighted asset RWA as capital. Capital structures divided into Tier 1 and Tier 2 capital. Risk weighting are assets are assigned different weights based on their credit risk. Risk weighted assets categories. Risk weight. Example 0%. Cash, gold, and government securities of home country. 20%. Claim on certain banks and highly rated securities. 50%. Residence mortgages. 100%. Corporate loans, commercial real estate, and most private sectors leading. The total risk weight assets RWA are calculated by multiplying each asset by its assigned risk weight. Thank you.
Now, let's move on to Basel II. Basel II was published in June 2004 by the Bank for International Settlements, and it is an international banking framework. Basel II consists of three main pillars. The first pillar is minimum capital requirements. It defines the rules to cover credit risk, market risk, and operational risk. This pillar focuses on ensuring that banks have sufficient capital to manage this risk. The second pillar is supervisory review. This pillar gives local regulators the power to evaluate bank risk methods. In the other word, regulators can review how banks manage their risk and assess whether their method is appropriate. The third pillar is market discipline. It requires banks to make public risk disclosure in order to improve banking transparency. This allows the public and other stakeholders to have better information about the bank risk. So, these are the three main pillars of Basel II: minimum capital requirements, supervisory review, and market discipline.
Hi, my name is Sachin Ganusargunan. My card matrix number is A25A4922, and today I'll be talking about Basel III. What is Basel III? Basel III is a global banking regulatory framework introduced by the Basel Committee on Banking Supervision (BCBS) after the 2008 financial crisis to strengthen banks and improve financial stability. What are their main objectives? The main objectives are to increase bank resilience during financial crisis, improve risk management practices, reduce excessive leverage, as well as strengthen liquidity management. Its key components are higher capital requirements, which require more high-quality capital and better ability to absorb losses, leverage ratios, which limits excessive borrowing by banks, minimum leverage ratio by 3%, and its liquidity standards, which are LCR, liquidity coverage ratio, the ability to survive a 30-day stress scenario, and NSFR, which is net stable funding ratio, promotes stable long-term funding. Basel III provides stronger and safer banking system, reduced risk bank failures, as well as greater protection for depositors and the economy. Thank you.
Now, let's move on the next section, BCBS and Islamic banking. Why the Basel Committee set global standard for banking stability applying tools to Islamic finance reveal a profound structural gap. This slide highlights the regulatory mismatch between global standard and Sharia principle across three key dimensions. Start with the first dimension, the conventional assumption. The core issue here is that the Basel framework is built upon an incompatible foundation. It assumes a traditional commercial banking model based strictly on debt, which completely ignores how an Islamic bank actually operates. Furthermore, these are interest-driven model where financial metrics are designed around interest or riba, because interest is strictly prohibited in Sharia. This conventional baseline is fundamentally incompatible with the interest-free nature of Islamic banking. Second dimension, universal application. Even though Basel was not designed for Islamic finance, mandatory compliance is forced upon Islamic financial institutions to ensure they can participate in global market and maintain international credibility. However, this strict application creates a severe regulatory mismatch. Standardized Basel formula are meant for regulators' rule, so they fail to accurately calculate the unit risk found in Sharia compliance contract. This forces Islamic bank into a difficult position where they must constantly find ways to adapt to interest-based global rules. Finally, we look at the actual Islamic reality, which operates on completely different economic principles. Unlike conventional debt, Islamic banking relies heavily on asset-backed structure, meaning all financing must be tied to real trade or physical economic activities, such as murabaha or ijarah. Additionally, it uses equity and partnership like mudharabah and musyarakah, where profit and loss are shared between the bank and the customer. Because the Islamic institution acts as a partner or a seller rather than just a conventional lender, it faces unique operational risks that Basel guidelines simply do not capture.
Benefit of Basel Committee on Banking Supervision, BCBS. There are four main benefits that I would like to discuss. First, BCBS enhances financial stability. BCBS developed international banking standards that help create a more stable global banking system. These standards encourage banks to maintain sufficient capital and manage their risk properly. Therefore, banks can become more resilient and the risk of bank failures or financial crisis can be reduced. Second, BCBS improve risk management. BCBS standards encourage banks to identify, assess, and manage different types of risk, such as credit risk and market risk. By managing this risk properly, banks can make better financial decisions and reduce the possibility of significant financial losses. Third, BCBS protects depositor and investor. Strong banking regulation can increase customer confidence in financial institutions. When banks operate in a safer and more controlled environment, depositors and investors can have greater confidence that their funds are being managed responsibly. Finally, BCBS promotes international banking standards. BCBS provides common banking standards that are adopted and implemented by many countries.
This helps create greater consistency in banking practice and also encourage cooperation between banking authorities internationally. Overall, these benefits show that BCBS plays an important role in making the banking system safer, more stable, and more reliable. Challenges of Basel Committee on Banking Supervision (BCBS). Although BCBS provides many benefits, there are also several challenges in implementing its standard. The first challenge is high compliance costs. Banks need to spend a significant amount of money to comply with BCBS standards. For example, banks may need to invest in new technology, risk management system, and employee training. These costs can be especially challenging for smaller banks. The second challenge is that BCBS standards can be difficult for developing countries. Some developing countries may not have enough financial research, technology, or skilled professionals to fully implement the standards. Therefore, the implementation process may take more time and require greater support. The third challenge is complex regulation. BCBS standards are detailed and technical. Because of this, banks need employees with specialist knowledge to understand and apply the requirement correctly. If the regulations are not properly understood, it may create difficulties in the implementation process. The fourth challenge is that BCBS standards may reduce bank lending. Under Basel III, banks are required to maintain stronger capital levels. Although this requirement has improved the stability of banks, it may also cause banks to become more cautious when providing financing. As a result, some individuals and businesses may face greater difficulty in obtaining loans or financing.
Hello everyone, my name is Dinesh Analaki Samunganathan and my metric number is A25A4978. Today, I'm going to present about reflection and conclusion. For my reflection, I think that BCBCS is important because it helps maintain a safe and stable banking system. From this topic, I learned that proper banking standards are important to reduce risk and make sure banks can operate safely. For Islamic banks, I believe they should continue adopting BCBCS principle while still ensuring Sharia compliance. This is important because Islamic banks need to follow international banking standard while also following the principle and requirement of Sharia. To conclude, BCBCS set global standard to strengthen banking supervision and promotes international cooperation among banking regulators. It also helps reduce banking risk and improve financial stability. By having this standard, it can increase public confidence in the global banking system. However, Basel II is mainly designed for conventional interest-based banking. Therefore, Islamic banking requires some adaptation to Basel II because it follows risk sharing and Sharia compliant principle. Overall, the Basel framework supports a safer, stronger, and more resilient banking system worldwide. That is all for my reflection and conclusion. Thank you.